Well, hello everyone. My name is Roger Scott. I'm the head trader for Wealth Press. Today is Wednesday, what is it? Today is May 13th. Wow. Where is this month going? I mean, really, where is this month going? It's amazing. I'm still thinking January, February mode. It really is crazy. Let's talk about the overall economy, and then remember, today is Wednesday. What do I do Wednesday? I always give you a hot stock with a stop loss and a profit target, and I even throw in the option for good value as well. So let's start with the global environment. Global markets were subdued Wednesday. We're in wait and see mode right now, folks. Stock retreated in London, Tokyo, and Paris, but reversed losses in Shanghai. Wall Street is pointing to small gains or very random trading action till we get employment data that's coming out tomorrow, and then retail sales, on Friday. India's Sensex jumped more than 2% after the government announced it would spend more than $260 billion more on help with the economy. That's a lot of money for India. Dr. Anthony Fauci, he's the gift that doesn't stop giving. He told Congress yesterday that if the country reopens too soon, it could only cause, I'm quoting, some suffering and deaths that could be avoided, but could even set you back on the road to get economic recovery. So according to good old Dr. Anthony Fauci, it looks like we may be going back to where we started. In China, where the virus first surfaced, authorities announced 7 new cases on Wednesday, not that much. 6 were in the Jilin province in the northeast, where alert levels were raised and rails connected suspended. And here is the bottom line. Markets will essentially be in wait and see mode for the next 2 to 4 weeks as investors gauge how reopenings are going. That's very, very true. Nothing is certain right now. It's all wait and see mode. But again, it doesn't mean we can't take advantage of the current market action. There are opportunities right now to the long side and more specifically to the short side. So we always start at our sectors. And right now, because the market's been kind of bullish for the last few weeks, and it's giving me signs that it's turning, we're seeing divergence in the S&P 500. We're seeing RSI levels get up to par. We're seeing rejection of the 200-day moving average. There's a lot of factors in the S&P. As a matter of fact, you know what? Instead of talking about it, why don't I just show you? I'm thinking this is a show and tell. Might as well show you what I'm talking about. So right now, we are looking at the S&P 500. And as you can see here, it's trading below the 200-day line, and it hasn't even reached for it. Now, if you look at the RSI, I want you to pay attention here. Notice we have higher highs here, right? And notice we have lower highs here. This is showing us that the RSI, this is the RSI oscillator, it's a 10-day RSI oscillator. It's showing us it can't muster momentum levels to make higher highs, even though price action is making higher highs. Now, if this sounds like a broken record, guess what the price action that we saw right here before the break? Price action went higher, but the RSI couldn't. See this right here? We were going lower here, and we were going higher here. And guess what happened afterwards? We saw this huge breakdown. So this RSI divergence is what we call it, is really, really instrumental. And it's telling us that the stock market may be getting a little bit overbought. Now, the majority of this correction, all the way from the bottom up to this moving average, that has been a short squeeze. That's short traders who made money on the downside correction in April covering their shorts. But the majority of price action since, the first of this month for the last 2 weeks, that it's been kind of trading on its own, and market's been looking for positioning. And so far, the broad index cannot overcome the 200-day moving average, and we're seeing divergence. That's not positive. The QQQ, the NASDAQ 100, on the other hand, boy, oh boy, there's no stopping it in sight. It's just killing it. Look at this. It just continues. It's almost at new highs. It's doing really well. But the overall market is not doing well, and as I explained to you many, many times, the reason that is because the S&P has financial, energy, industrial, real estate, utilities, materials, consumers, while the NASDAQ 100 only has, when I say only, it's got like a handful of the others, but mostly it's got tech, healthcare, and consumer discretionary, and those three sectors are, I'll do that again for effect value. Come on, guys, it's Wednesday morning. I gotta have some fun around here too, right? Anyways, these three sectors are doing well, and that's why the NASDAQ 100 is showing no signs of pulling back, where the utilities, real estate, industrial, energy, and financial stocks are pulling the S&P down and causing it to diverge, as you saw here. I'm not happy about this divergence. It's telling us that this RSI oscillator cannot sustain higher price momentum levels, and that's already after this correction. So this is very meaningful. Take these divergence periods seriously. Now, today is Wednesday, and you guys know what Wednesday is. Wednesday is red meat. We cut the meat, we give you red meat, we give you a trade. So let's talk about what we're looking at today. I'm really looking at the industrial sector. I think energy sector has bottomed out a little bit right now. At least, if not bottomed out, it's given us a swing low for quite some time. But I think the industrial sector has more upside. I think there's definitely more upside in the industrial sector. So I like the industrial sector, and one of the weakest stocks right now in the industrial sector, as you can see here, indices, S&P 500, we're looking at one time, GE was the biggest stock in the world. In the world, that's right. But those days are long, long gone. And right now, GE is close to making all-time highs. I mean, this stock is not looking pretty. To give you an idea, let's get this chart. Look at this. We had this correction. We went up from $6 to like $8, and now we're all the way back down, and it looks like we're going to break the low. And it looks like we have let me just draw this. Looks like we have a descending triangle. And whenever we have a descending triangle, they usually are bearish patterns and they break down. And based on what I'm seeing, I don't think GE's got enough mustard to break up. I mean, if you look at a 10-year, 20-year chart, this sucker's just not having any love. And guess what? They just announced that they laid off 13,000 employees. And guess what else? They are involved in the airline business. They make jets and propellers. Not jets and propellers. I don't know where the propellers came from. Jets and turbines, excuse me. And as you know, based on what Warren Buffett told us last week, airline industry is not doing well. So I like the $6 price level. Option premiums should be cheap. Let's look at the options. In this case, I would go 717. That gives us 66 days. That means we can liquidate the position if it's not doing anything in the next 20 days. And I would go, I mean, these are cheap. Look at this, 57 cents for a $6 strike price with 77 days. Look at the open interest and volatility. I mean, this thing has a spread of like 3 cents. So I like the $6 strike price put. I like the 717 expiration, that's 66 days away. If it doesn't do anything within the next 20 days or so, we just liquidate it. And to give you some idea, let's look at the chart of GE here. If you're trading the underlying stock, what I would do is I would wait for a break below this blue line. I would wait for a break right around the 580 level. And I would put a sell stop, and I would trigger that stop. And if it goes back up to the 658 level, I would cover my short. So we're shorting it at 585 on a sell stop, and we're covering it at how about $7? If it goes to $7, the trade isn't valid. And you would trade the option as a proxy. You would buy the $6 strike price put option, not the call, the put option. You would buy the $6 strike price once our sell is triggered, and if it goes your way, I would ride it for about double or maybe even triple profit. I would ride it all the way down to the $5, maybe $4.50 level. And if it goes against me, I would cover it around $7. So again, GE looks very, very bearish. And again, About 15, 20 years ago, GE was the biggest stock in the world. Now, before I let you go, I want to remind you that you're invited to join today's meeting at 2 p.m. Eastern Time in the exclusive New Money Club with Lance Ippolito. This is going to be great. We're going to have an amazing time. I can't wait to see it. We're going to have Josh Bellinger there. I believe Rob Booker's going to be it. This is going to be really cool. During the meeting, you'll learn the secret power move that could have made you not $500, not $1,000. How about $35,822 in pure profit in one day? I know you're probably thinking something is wrong or I'm misreading. I'm not. $35,822 in one day. That's life-changing. I got to get in on this New Money Club. And how even in the middle of this crisis, the New Money Club members are still raking in huge profits every single week. You don't want to miss it. Today's your chance to see exactly how you can turn $1,000 into $14,000 overnight. Click the link below or follow the button at the end of this video. You don't want to miss out. Lance Ippolito is a master trader. He's going to have some guests on there that'll blow your socks off. You don't want to miss it. Folks, anytime you have an opportunity to join a session at 2 p.m. Eastern Time today that could make you $35,822 in one day, that's a session you definitely want to attend. Hope it helps. I'll talk to you guys soon. Take care.